Okay, great. Okay, now I shall just jump straight into the main topic for today. Okay, again, the key thing here is this. Please take away something from me. I am the teacher. I'm the teacher. I a professional trainer. So you're going to spend 2 hours with me. So please take something back from your 2 hour investment now, which is today at the end of this session, you have a framework of how you should invest in 2024 or how you should deploy your funds. Okay, so that is the main objective. So let's go through the market outlook first. It's actually good to have a sense of where we think the market is going. Yeah. Okay, let me start by sharing what happened last year. So this is the US, China, Singapore performance. The blue line is Dow Jones, DJIA. So this is for 2023. The red line is for STI, Singapore. And the green line is China. So Shanghai Composite Index, China. Okay. So you can see that basically they decoupled. So US, wow, fly like crazy since November. Take off already. Singapore is on the ground. So far still sideways, very stable, sideways markets. And of course, China sort of have a little plunge. Okay. So of course, with this, it led me to ask these few questions. So number one, is the US bull run justifiable? So that bull run up, is this justifiable? Is it going to continue? So this is the question I have in mind. And number two is it likely for SG to catch up in 2024? So can SG go and close the gap or not in 2024? And so is it really don't bother about China? So when I actually saw this chart, these are some of the questions that come to mind. And of course, I did my research to get my answer to these questions. And this is all forecasting. So end of the day, it's assumption. It's assumption. You don't have to agree with me. Again, like I said, it's the process that matters. Okay. So before I share my research, my analysis, of course, must talk about my disclaimer. So basically, education purpose, not investment recognition. Long story short, make money, be happy, lose money, don't scold me. And the main part is this, so that these are a demonstration on what I actually do to plan my investment journey. So whatever suitable for me may not be suitable for you. So we have different investment objective and risk appetite. So please use as a guide for your own investment plan only. Okay, so standard disclaimer. Okay, let's talk about the US markets. So now my analysis is quite standard. Hopefully by now, most of you know how to do it. I just look at two things. One is the key indicators. Can someone remember what are some of the key indicators I look at? PMI, thank you so much. Purchases Managers Index. And what is the other one? Unemployment rate. Okay, unemployment rate. Okay, thank you so much. So I just look at these few key indicators. So of course, the other one will be the US GDP annual growth rates. So you can see here, indeed, not too bad. The growth rate has been actually going up, but in terms of absolute number, not that spectacular, 3.1, which is okay for developed nations about there, 3.1. So from this perspective, okay, this one is actually not too bad. It shows a very nice picture. Okay, unemployment rate. So, okay, this is the one I probably want to spend some time now. Unemployment rate, let's be clear, higher better or lower better? Lower, thank you so much. Okay, but for US case, I am a little bit concerned. Now, can you see a very interesting pattern for the US? So every time it come down lower, which is good, but then it will spike up. And can you see? Okay, every time you go down, then you will spike up. Every time you go down, you spike up. So this has been happening for how many years? This is since 1950. So by right, I should be happy that the unemployment is down, but I don't know, man. I don't know what is the likelihood for it to break the history. So if history is a guide, there is a probability that it may actually spike up again. Okay, I don't know. This is actually basically based on history, but unfortunately, I think I'm able to justify with the fundamentals as well. So with the interest rate has been increasing over the year, there could be a likelihood that it may has been too tough already, or can go and cause into a negative spiral. Okay, so this one I do have my concern. This is actually I do have my concern. So again, unemployment rate down is good. Okay, but it's just that for US case, you can see historically, every time it go down, it will spike up. So spike up, of course, is actually quite bad, okay, for the economy. So this is one concern I have. Okay, next is actually PMI. So PMI above 50 is good or below 50 is good. Above is good. Thank you so much. Above is good. So you can see actually for US, it's not that spectacular. So this is the 50 mark. This is the 50 mark. So in fact, for whole of last year, or in fact, for the second half of last year, barely actually go above 50. Can you see? Only in Jan 24, then actually went above 50. So, and I don't know whether this is sustainable. Okay. So basically, from these numbers, to justify for this kind of spike, okay, I don't think it's just I don't really see that they're in line. Like for example, if you tell me economy is good, economy doing very well, then you have spike, then okay lah, I agree lah. But what I am seeing is the indicators are not that supportive of that number. So this is my opinion. Okay, so after looking at indicators, the other part is just look at stories. So it's actually quite standard one. So like I said, hopefully you all can also do it for yourself. Economic analysis, just two part. One part look at indicators, then the other part look at the story lah. So for this story, what I did was this. I go and figure out what is the one that triggered the market to go up in the last quarter of 2023. Basically, is the interest rates. Okay, so what happened here is this: Fed Reserve initially actually stopped the interest rate increase. So I think in October period, they actually stopped increase, and they actually signal interest rate cut in 2024. And that has caused the stock market to spike. Okay, so this was the reason. A bit about the theory part. I think most of that actually gone through this, the relationship between interest rate and the economy. So of course, when the interest rate is down, people are more willing to borrow. So think about it like buying properties. So when interest rate is low, people don't mind go and buy properties because the borrowing cost is low. So when they go and buy things, the demand for goods and services increase, then company produce more. Then after that go and they will employ more people get employed, then more people get employed, then after that, more people have money, then they will have higher demand for goods and services, and they go into a positive spiral. Okay, so that's a relationship between interest rate and the economy. So of course, if the economy go into positive spiral, more goods, company produce more labor, people get employed, things are better. Okay, so the other way is what? Where interest rate go up. Okay, reverse work through, reverse go up, people borrow less, then the economy may actually go into a negative spiral. Also, that is how the relationship between interest rate and economy. So hope you all can remember, we actually went through this in the lessons that you've done. Of course, we actually have done the lessons for a very long time. The relationship between interest rate and the economy. So the question I have here is this: will Fed really cut the interest rate or not? Okay, will Fed really cut the interest rate or not? So I actually found this article quite interesting. Let me just read to you. So what are the scenarios for, or why does the Fed cut interest rates? The two most recent cases of rate cuts highlighted two primary reasons. the Fed lower its benchmark lending rates. So the Fed cut rates when something goes wrong in the economy. Okay, so that was the premise of rate cut that began in 2007, 2001, and 1990, which marked the start of different recession. Okay, the Fed also cut in response to data that show economy is losing steam. Okay, or after event like 9/11, that could be generate weakness across the economy. So the story is actually like this. Now, people are actually expecting Fed to cut rate. And this is the reason that the market actually went up. So the thing, what this article says is, but the main reason for Fed to cut rate is when the economy actually doesn't do well. Okay, see what I'm trying to get at. So if let's say, before they cut, they probably need to have a point in time where they can't do well, then the market may actually come down. Then they actually talk about cutting rate. Okay, so of course, all these are speculation. At the end of the day, we don't know what the Powell guy is actually thinking of. Okay, the Fed research is actually thinking of. But if you actually go by Economics 101, you need to have something wrong, then you talk about Fed cutting rate. So of course, if indeed something goes wrong, you cannot have the stock market keep going up. So in this same article, he also said that, but this time around the cutting could be different than any other time. He said in his view, the Fed will cut next year because inflation will move closer to central bank 2% target. However, they also say that they are not ruling out a recession in the coming year. The Wenders team predict unemployment rate will rise to 4.6%. Okay, as a result of drop in national real GDP. Okay, the stock market go up because they think that it's going to cut rate. But for them to cut rate, okay, there is a chance that the economy don't do well. So which means to say the stock market cannot go up forever and just keep going up. There can be a period whereby, because you want to do well, that means stock market come down, then the cut rate, then can go up again. So it can be a potential scenario. Okay, so however, now everybody think that it's going to cut rate already. And if let's say, for example, if they don't cut rate, then again, the stock market may come down. Okay, so to summarize the few slides above, I know it's a little bit confusing. So to summarize whatever I said, I believe there can be these three scenarios happening, okay, probably in the next 6 months, next 1 year. Okay, the US actually still cut interest rate even when economy doing well. So of course, this is the best scenario, positive scenario. Okay, everything's still doing okay. Then for whatever reason, US still cut rate. Then of course, the stock market will continue to go up. Okay, I believe there can be a scenario where since the economy is doing very well, then there's no point for US to cut interest rate. Then there's no reason for US to cut interest because we have just seen that in the previous few rounds, the US cut interest rate because the economy is not doing well. And yet we have a case whereby now people keep thinking that US will cut rate, and US don't cut rate, then of course the stock market will actually plunge. Okay. And of course, we can have this scenario whereby the economy not doing very well, and then the US cut rate. So of course, economy not doing well, the market will plunge. So this is what I summarize based on the previous slides that I have mentioned. So going forward, US can have this three possible scenario, of which only one that's positive, whereby economy do well, US do cut rate. Now, of course, you will see the US market keep going up very nicely. But whereas these two scenarios can also occur, then probably you won't see a very nice bull run up. I am also in the opinion of this part 3, whereby economy not doing well, and that's a US cut rate. So if you see this, then it actually tie in very nicely with my chart here. Can you remember this chart? Okay. which means to say I think there is actually still possibility of a spike. So this is my opinion. It seems that the fundamentals may support that as well. So this one will just help me as a basis for my investment strategy. So for my US, my base assumption is a roller coaster lah. I do see, there will be a huge correction, okay, before that we actually come out again. So this is my base assumption. Like I said, you don't have to agree with me, and I could be wrong, okay, but this is the assumption I actually want to use when I plan my investment strategy for 2024.